Hello? Oh boy, that's much better. Okay. All right, well, thank you. Thank you all for coming, and I'm really delighted to see so many of you that I know and many that I don't know as well. I'm Deanna, Kory, and I'm obviously hosting this event, and it's in this very special apartment. And for those of you who don't know it or haven't been here, I'd love to see a show of hands of how many people have been at the building in the past. Oh, quite a few. And how many are seeing it for the first time fully constructed?
Yeah.
Oh, first time and fully constructed, which is fabulous because it's an amazing building, and we're sitting in an amazing apartment that is at the base of the tower, and it's got these incredible 22-foot ceilings, which Ken will talk about. I wanted to introduce you first to Ken Horn, who is the developer of the building. He is with his company's named Alchemy, and it's been in existence, I think, for like 30 years. Is that right? And he's been developing a lot of amazing buildings over those years. 25 is what the bio says in all.
Actually 30 now.
Whoa, it's growing every year. And this year I think you said you have 3 that are in development. And they're all, I have to say, the ones I've been to have been incredible and all unique and all very special. He's overseen the sale of $2 billion, and probably now it's closer to 2.5 or $3 billion. And he is very often personally involved and quite an extraordinary man. He lectures at Yale University School of Architecture, the Wharton School of Business, and NYU's Master Program. And he's also an attorney, a great attorney, a personable attorney. In addition to his day job, he also is on the board of a place called the Catalog of Giving that supports after-school children's programs. But in my opinion, the most important thing is he is a real mensch, a real human being. No, I'm not even kidding. He's an amazing person, an extraordinary developer, and I feel very privileged to be working with him, and I want to turn this over to Ken.
Thank you. First, thank you all for coming. Joel Breithoff's my partner. We greatly appreciate it. So what Deanna asked me to do was just to give a little history about how we got involved in the Woolworth building and how it turned out the way it did. So if I roll back the clock, Joel, 6 years ago? We were asked to look at the Woolworth building by a well-known individual who has fallen from grace, whose name I will not discuss. At any rate, we were asked to come in. And the way the building was done at the particular time is there was an ownership structure for the entire building. Ostensibly, everyone in New York owned a piece of the Woolworth building. It was almost like the producers, from what I understand. But the upper 30 floors of the building were vacant. And they had been vacant for 10 years. And the reason they were vacant is because there were a lot of real estate owners who owned the building and just couldn't decide what to do with the upper 30 floors. Whether or not to make them residential, a hotel, rental, condominium, office. So Joe and I were asked to come down, more out of curiosity because it is the Woolworth building, and we walked in here and we said, we're going to buy it. We're going to buy the upper 30 floors. And we looked at each other and we said, are we crazy? 44 days later we closed. A $68 million purchase, but just to let you know the complexity of it, a lot of times as a developer, one buys a site, one buys a piece of land, one buys a building. It's complex, but not as complex as this. Because here, we only bought the upper 30 floors. We didn't buy the lower 30 floors. The existing ownership maintained the lower 30 floors, so what we really had to do was create 2 separate condominiums. We had to create easements, we had to create all the legal aspects of moving ahead with 2 separate condominiums. We did that in 44 days. We were able to bring in our partners, we were able to bring in our lender, and the closing took 3 days to go through. And after the closing, when I counted all the lawyers in the room, Joel and I kind of looked at each other and we were overwhelmed with a sense of responsibility. We always like to do the right thing when we develop buildings, but here the sense of responsibility was that much greater because of what the Woolworth building really is. So over the course of the next 11 months, we put a team together of historical consultants, architects, engineers, attorneys, everyone you could think of, because in order for us to move ahead with this building, we needed a lot of cooperation with New York City landmarks. In the past, we've done probably about 8 or 9 buildings with landmarks. We have a great reputation down there, but nothing like this building. So we brought in Thierry Despont, who is a well-known architect in New York. He's the design architect of the rehabilitation of Statue of Liberty. We brought in a firm called Higgins and Quaysbarth, who's the most well-known historical consultants in New York. We brought in Melanie Myers from Fried Frank, who's a very well-known zoning lawyer. And 11 months later, we put together a package as to how we were going to present to landmarks and what we intended to do. Interestingly enough, when we did the presentation, we were unanimously approved. And just to show you the difficulty in that whole ordeal, in all the buildings we've ever done in New York, and most developers never get unanimous approval done at landmarks. It just goes to show you the thought process that went in to really developing this building. By way of example, if you look outside the building, there's terracotta. This is a terracotta structure. And what we ended up doing, we found a successor to the original company who built the building, the Buffalo Terracotta Company. And we decided that what we were going to do was to restore the facade. So there are now 3,500 pieces of new terracotta on this building. We actually had 21 hanging scaffolds off the building. We reduced the exterior into 1 foot by 1 foot increments, and we made a determination what we were really going to do. So there were 3,500 new pieces of terracotta. We redid an enormous amount of the facade to the tune of $22 million. So what our obligation was, truly, was under the local laws, was just to restore the facade, which would have been $2 million. But we realized that most of the people who are going to be buying this building really wanted to make sure that the building was perfect. So it took us a long time to really build this. And I know a lot of the brokerage community probably out there said, gee, what's taking them so long? What really took us so long is, of all the 30-some-odd buildings we've done, there's nothing been more complex than this. So if you really look at it, we don't own the lower portion. The only vertical method of transporting any kind of construction materials were from those 2 elevators that had been cut by the previous owners. So our design was dictated by where those elevators were, because those elevators obviously go through space that we don't own. So we were not able to put a hoist on the exterior of this building. We had to put 2 lifts through the building. While we were building 1 elevator, we were using 1 lift 24 hours a day to move materials up and down and up and down and up and down. We put all new windows on this building. The other thing we did, which was particularly interesting, is that there were 2 elevators that provided service from 0 up to the top of the building. We didn't need those elevators to go to our space anymore because they were really office elevators. We truncated those elevators. So we cut those elevators down floor by floor, which enabled us to pick up more saleable space in this building. So when we really got involved in designing it, we realized that the units had to be grand units. We were not going to make this building into a cookie-cutter building. We were really insistent on making them beautiful, luxurious, and what we had to do is we had to take the pre-war nature, the Gothic nature of this building, and incorporate it into a modern interpretation, which is really what I think we did. So now we are finished. The unit that you're sitting in and the adjoining unit were perhaps the most complex that we did here. This floor didn't exist. So you're on the 29th floor. In the past, the 29th floor had 7-foot ceilings, Joel, maybe? 6.5-foot ceilings?
5.5.
Yeah, and basically what it was the catacombs of all the mechanical systems that served the building. So what we ended up doing was we just took that out and moved it, and we depressed the floor. And on top of the area that you're in now was basically the mechanical equipment that serviced the entire building. With the cooperation of the lower portion, we took that antiquated items that really provided heat and air conditioning, and we moved it down to the 2nd floor. With Landmark's consent, they allowed us to build these 2 pavilions. So these did not exist when we bought the building at all. So what you're sitting in, this and the adjoining unit, are really the new construction aspects of the building. Again, the concept here was to keep them in line with the basic design of the building, and I think we were able to achieve it. So for instance, if you look outside and you see the cresting and you see all the, all the design elements, those elements basically are reflective of what's in the renovated units that we did. So the care that we used in the new portion was almost identical, if not even more so, than what we did in the old portion. So where are we now in the building? The building is finished. I know many of you probably have been here during the renovation. Maybe some of you actually went up in the lifts, which probably was not that much fun, because they were noisy and they were slow. I was the first to admit it. But now, over the last couple of months, for some reason, we've had a great resurrection in this building. We have 4 contracts now out for signature. We have 3 more we're negotiating. And for some reason, now that the building is done, the Woolworth building is really taking off. So we appreciate you coming here. I know that the panel is really going to be discussing the status of the market, so I just gave you a little microcosm as to where we are in Woolworth. As Deanna alluded to, we're developing really 3 other buildings. One of them is 250 West 81st Street, which I'm sure many of you may know. Robert Stern designed it. We only have 1 unit left. In 2019, we raised prices 6 times, a bit of an anomaly. We're also finishing our building at 50 West 30th Street, which is about a 60-unit building. Tim, I think we have, 12 or 13 units left. Again, over the last couple of months, for some reason, market's kicked up, and we are starting to develop another building on the Upper West Side, which was the old collegiate school. We bought 378 West End, and again, speaking of complex, there were 3 buildings that were 1950s vintage in a landmark district. Landmarks gave us consent to take those buildings down. They were also adjoined to an existing landmark building, which was part of the collegiate school. So what Landmarks has given us consent to do is basically build another building and connect it to the landmark building on West End and 78th. Again, for some reason, nothing we do is easy, and maybe that's just our niche. Every developer in New York has a niche, and our niche probably is to take our heads and knock it against the wall and hope that everything turns out. But we do believe that here, that has been the case. So we appreciate you coming and enjoy. Thanks.
Thank you. That was great. I really appreciate it.
Okay.
I also
See
want
everybody.
I also want to mention that we have the other pavilion open for you to see after this, and other apartments. We're going to have somebody stationed there, and also, I think it's on 31. Where's Josh and Tate? Is it going to be 30?
So I'll be across the hall with Pavilion A.
Okay.
Tate will be at 36.
36. Okay, and there is an amazing Art Nouveau, did I say that? Art Deco pool, amazing wine cellar at gym, a wonderful gym, just so you know, and a lounge on this floor for residents. So just to give an overview of the building. All right, so now to our panel, and I love this panel. I wanted to introduce each one by one and sort of out of order, but the first person I'm going to introduce is Ryan Schleis, who is right here. And for those of you who don't know him, he's the Senior Vice President of Research and Analytics at the Corcoran Group and Corcoran Sunshine Marketing Group, and also City Habitats. He's the one who really guides all the market data that gets produced and put out, the Corcoran Report, which is a quarterly publication of not only Manhattan and Brooklyn, but also Long Island's East End and Palm Beach. He happens to be a graduate of Stanford University, no less, and is a wonderful speaker. We're so happy to have you here. Welcome, Ryan.
Thank you.
And I have known Noah, I think it's been maybe 10 or 14 years, a long time. And I've been a big fan of his, honestly, for all that time. Noah is the founder and CEO of UrbanDigs, for those of you who don't know it. Does everybody know UrbanDigs? Yeah. Oh, yay. Okay, excellent. Well, that's great, because I think it's an amazing site, and he's done an amazing job. He's a Manhattan-based residential real estate data and analytics company, his company. But he's also an expert source for real-time market information. So that means contracts that are being signed and relevant market insights and trend analysis. For those of you who don't know UrbanDigs, it's one of my go-to websites, and I really think you need to go to it. I'm a member, I wholeheartedly support it, and I go there to see what's really happening right now, and I applaud you, because nobody else that I know of is doing this. So anyway, it's chock full of a lot of great information, and I thank you, Noah, for being here. And for our moderator, we welcome Ryan Fitzpatrick. Now Ryan, for those of you who know him, he is the managing director, senior managing director, heading up the Corcoran Chelsea office. But what are the chances of me not realizing that he's another Ryan who went to Stanford University? So, oh my goodness, I thought, wow, we have all these brainiacs in the room, and the data analysts, what am I doing here? Okay. Anyway, so he's a brilliant fellow and a really all-around nice guy, and we're really lucky to have him as one of our managing directors. So welcome, Ryan. He's going to moderate the panel. So. And for those of you who don't know me, I'm Deanna, Kory, and obviously I have an amazing team, most of whom are here if they want to raise their hands. And I've built it up over many years, as you may know. I've been doing this about 35 years, and I love data analytics, although I don't keep the kind of records they do, so I'm going to speak from an anecdotal standpoint. But I wanted to just welcome you all, and I just appreciate the turnout, and I hope you enjoy our panel. And thank you for coming.
Thanks, Deanna. So first of all, to those of you back in the kitchen, we have a few seats up in the front if you'd like to step up and join us. We've got a lot of good content to cover today, so I'm going to open this up by asking about what has happened in the recent past that would help predict the future. And I'm not talking about today's headlines. A little less recent than that. But Noah, I'm gonna pass this your way.
Sure.
For starters.
Hi, I'm glad you're not talking about the rent regulations, because that's it's a little confusing that's going out there. But basically, look, I look at news, I look at contract activity, and I look at a tool that I have on UrbanDigs that's called the Market Pulse. Is this working? Hello, can you hear me?
Yes.
That is called the Market Pulse. News, I mean, we're in a policy-driven reset here. I mean, we've had the SALT deductions, we've had the mansion tax, we've had the rent regulations, we have a strong US dollar, we have China capital controls. Every reason that there is to not bully the sales market is what's going on in a policy perspective. And what happened yesterday is another policy change that all of us is going to have to just kind of understand what's going on there, including myself. But you know, all of that at the end of the day impacts the real-time market. What I mean by the real-time market, I like to think of it as a trader would. Like I'm an equities trader by heart. I used to be a day trader. And as a day trader, you have a bid, you have an ask, and you have a spread. Okay? And who was doing business back in 2013, 14, and 15? Could you guys please raise your hand? Okay, so tell me if this sounds normal. Back in 2013, 14, and 15, the bid-ask spread was very narrow, okay? And there was no inventory, and a lot of deals were going into bidding wars over ask. And if you were a buyer back then, you had no options, you had no negotiability, and it was just crazy. Would you guys agree with that?
Yes.
Okay, so since 2015, something's changed, and that's policies. And it's taking 4 or 5 years to get to where we are now. So buyers have basically been pricing in these policies. Something happened in 2016, and 2017, and 2018, and 2019, and it's been one hit after another. When I look at bids and I look at asks right now, I see bids down here, I see asks up here. Do you guys feel the same way? So that spread between bid and ask is widening. So if you ask me how I try to predict what's going to happen in the next couple of months, I look at that spread, that negotiability, how much are sellers going down to get deals done, listing discount. Even though that's a lagging indicator, it's not real time. A real-time indicator would be contract activity. And I can tell you based on that real-time measure of contract activity, I'm starting to get a little excited. I mean, it's something I haven't seen in 2.5+ years now. November was good, December was good, and January was good. I don't remember the last time we saw 3 months in a row of increasing contract activity. And from what I'm hearing anecdotally, a lot of agents are reporting urgency. Packed open houses are starting to happen. Now, I'm hearing that a lot of product is not of a high quality out there. So like if I'm a buyer out there and there's 40 units to look at, maybe 5 are really good and priced right, and the other 35 are kind of lingering. But I'm hearing traffic is up, I'm hearing urgency is up, deal volume starting to go. Where those deals are happening, we're not going to know for another 2 to 4 months. But are you guys seeing similar things in your business? Okay, so that to me is going to tell me that pending sales is going to rise, my market pulse figure is going to rise, and if history is any guide, you got to wait about 6 months for the sales figures to follow suit. So I really do expect that by the summer or by Q3, we're going to start to see some year-over-year increases in median sale prices. I actually believe the bottom of this market was sometime in mid-2019 and fall 2019, right when that rent regulation hit in July. Right. The real-time dynamics in the market at that time was strongly favored to buy side. I think it's starting to come back a little bit.
Great, I'm going to stop you there because that's a great inflection point, literally and figuratively, to talk about when you think in the rearview mirror, we may have hit bottom, which is interesting because that's always a fool's errand, right? To try and guess the bottom of the market in I think all of our experience. So speaking specifically about prices, and I'd love to get Ryan and Deanna involved here too to hear your thoughts about sale prices. Do you feel that we are now in an upward swing? Do you think we've stabilized, or are they still going down? Is this market segment specific? Sorry for the feedback. Or what are your thoughts there, Ryan? Do you want to?
Sure. So I hate to predict the future, but I will a little bit as long as nothing's being recorded, right? Is that
Only two.
okay? I will put it in writing. But because I slightly disagree a little bit with Noah, which is always fun on the panel, right? I think that we're not quite at the bottom of the market yet. What I'm seeing is some, silver lining, some green shoots, and I'm definitely seeing the same thing that Noah is talking about in terms of the signed contracts being up. They're up about 6% by our analysis in fourth quarter. That's continuing into January. It's interesting what you were saying about then that coming forward into the closing numbers later in the year, which I think will be really interesting and helpful because we all know that the press and the buzz tends to center more around the closing figures, even though that's not really the real pulse of the market, but because that's what's in the market reports, that is what they key into, and we're gonna need it at that time because we'll be into the election season full throttle when we all know a lot of people will also be pulling back. So because if it weren't for the election coming up, I would say that I would be potentially agreeing with you, but I think it's more going to be like October 2020 is going to be the bottom, and things then will be turning up in spring 2021. In terms specifically of prices, I do think with the inventory picture starting to flatten, but there is more new development coming, so I do expect inventory to tick up a little bit more through this year. And that will continue to put some downward pressure on prices. So I think prices are going to be at best flat for a little while longer, perhaps come down a little bit until we get through the election. But your point about is that neighborhood or market segment specific is really important because we definitely are seeing much less price sensitivity in the lower price points as you'd expect, where the market, in supply versus demand is more tight in the resale co-op market, or the market, let's call it under 2 million, versus the higher end market where there's still a lot bigger spread between the bid and ask, like Noah was talking about.
Deanna, I'd love to hear from you back on the ground, anecdotally, so to speak. What are you seeing?
Anecdotally, what you just said about it being very price and market specific is absolutely, in my experience, happening. And I'm sure everyone here is feeling the same thing. The lower the price point, as long as it's a good apartment, the easier it is to sell, and the more kind of open house attendance and more bidding, even multiple bids that we're starting to see, which is really great. But once you sort of hit that, although it's it goes up and down above the $4 million and $5 million mark, the picture changes dramatically, as we all know. But we are seeing a little glimmer here and there. What I am also experiencing, and I wonder if you all in the audience are, is whenever we get a new article, and we're going to talk about the press in a little bit, which we got that new article about the taxes, I don't know if we'll get to that in a minute, being put on parity, so taxes may go up, or when we get something about the landlord-tenant or anything like that, it does kind of, I almost feel, and I don't know if you all, I'm curious, feel sort of a pause in the market. It feels as if people are saying, oh my gosh, what's happening? And they kind of pause for a little bit. Is everybody else, who else is kind of sensing that when they get these articles in the paper a little bit? But I think it is, again, market specific, because I think if you're a first-time home buyer, or someone who's maybe buying their first home together with their significant other, or, then you're just doing it because you're going to be here for the long term, and you're not thinking about those things as much. That's part of anecdotal information from my point of view.
Great. Hey Ryan, I just want to add one thing. Sure. Everything is local, right? So every building is going to trade in its own way, right? Even if you're in a Tribeca condo market and you have 10 developments, they're all doing their completely different things, right? So you get outside that building and it's a whole different market. And what Ryan was saying at the end, it's really important for you to understand the sector that you're in. We went through this aggressive price point specific downturn that, you know, in every downturn, the higher end tends to get hit a little more, but I feel like in this downturn, Ryan, that the new development in the super luxury sector specifically kind of got really hurt. With the recent rent changes in July, the multifamily and the townhouse market just got really hurt. So like if you were to talk about how much are we down, I think, you know, without isolating, there's no chart you can pull that specifically says this because of the mixture of volatility of what makes up the sales, but I mean, I'm hearing some reports that super luxury, 10 million plus, and 30–40%, some deals from the peak in late 2014 to early 2015. 5 to 10 million sector, I'm hearing some people take 20% haircuts from the peak in 2015. But then you get to the 2 to 5 million sector and the 2 million and under sector, and it's a much different story. The 2 million under sector, maybe it's down 10% over the last 5 years. Some properties in the East Village are trading higher today than 5 years ago. Some properties in Upper Manhattan are trading higher. Some Upper West Side markets are really doing very well right now. So it's really a very specific segmented market, and if you're working in one sector, you just need to kind of isolate what's happening there.
Yeah. So clearly there's a lot of factors and variables influencing this, and I wanted to ask a little bit about, you know, what you see as a catalyst for further, you know, increase in sales prices and for positivity. I think we've certainly covered the negatives because we've had a lot of headwinds in the last couple of years, in the last year in particular, as you pointed out, Noah. But and Ryan, you already mentioned the election. That's probably the biggest potential obstacle in our way. But what could be out there that might lift our sales further?
I mean, I hate to say this, I just don't see. I mean, there's talk of a pied-à-terre tax. I mean, have you guys heard about this? There's talk. That's positive. No. Again, I don't see any positive things on the horizon that could turn this whole market around. This has been a completely policy-driven reset. We got one again today, and again, this talk with pied-à-terre tax, that talk is damage enough. That's enough to do kind of damage to buyers and make them pause. I don't see any policies getting changed. There was talk that the rent regulations last year would get scaled back. That could be a positive. That could be a very good thing. So I'm sitting here thinking, what could be a positive? Your supply and demand dynamics right now. They've been favoring buyers heavily for a long time. If we get to a scenario where inventory starts to decline, and I happen to be in Ryan's camp, I think inventory is going to trickle up a little bit, unless demand just starts doing some crazy things and all of a sudden the inventory starts to normalize and go down a little bit. But if there's an urgency, if we start to get an urgency back in the market and those buyers start to see packed open houses and listings going into contract, you might see a little bit of a shift in sentiment on the consumer side. On the buy side, that might start to change these numbers around. And that's the only thing I think that's going to change it. I don't see anything from a policy perspective or a news perspective that's going to come in and just change everything.
So this is where I slightly disagree again because I don't think it's true to say that it's solely a policy-driven reset or downturn. It's also a supply-driven. There's the supply that's out there is not necessarily well matched to the demand that's out there. So we need a lot of that supply to reset in price and clear out of the market. And as that happens, I think that could drive an uptick as we sort of deal with some of these things that are out there that are making it seem like there's a lot more supply than there really is. I think it's telling what you were saying about how there's, you know, you do a search, it looks like there's a lot of listings, then you actually go look at them and they all kind of suck. So I'm actually kind of been looking around for an apartment myself, so I'm like, oh, values have come down. This seems like a good time to look, right? Using my research brain, and I don't like anything, right? So I think we need to sort of clear through some of that supply issue. People also don't like to buy when prices are going down. That makes them afraid. They like to buy when prices are going up, even though now they might be, you know, not getting as good of a deal anymore. I think I need to memorize, there's some old Warren Buffett adage about, I think it's the stock market and real estate that people only buy when prices are going up, right? So I think that once people feel that the prices are starting to turn the corner, that will definitely generate an uptick in the marketplace. It's just hard to say when that will happen. The thing is, lowering prices, while on its face seems bad because some people are going to lose some money, we're maybe making a little bit less commission, right? But the reality is the lower prices will mean more people can afford to buy the apartments. So once people sort of realize that affordability is back in their favor because some of the pricing is kind of equalizing some of the policy-driven things that are changing the affordability equation, I think that will spur people into the market, especially as long as mortgage rates remain so low.
Great. Very helpful. So all that, I think we're going to hold questions actually till the end, but we definitely will allow some time for that. Thank you. We're sitting here in this beautiful apartment and in a piece of New York history. So I want to talk about specifically the new development market, because despite some of the comments we just heard, we anecdotally, I manage a big office. I see a lot of deals happening especially since the new year, and many of them in new development when they're priced right. And this is truly unique property. They're not building any more Woolworth buildings. And given the story Ken told, this is a one of a kind. So there are buyers for that property. People who really want something that meets their needs. When it's priced right, it will sell. That's my take on it. But I'd love to hear, in general, what you guys are seeing in the new development market, sort of statistically, and then, more anecdotally too.
I'll start quickly. For sure, I 100% agree with you. We actually are seeing the improvement in sales in the marketplace actually centering in the new development market, and there's a couple of reasons for that. The greater negotiability in the new development market means that it's stealing market share away from the resale market, particularly resale condos, obviously. So the new development market has kind of been the bellwether of things turning around on the sales side, particularly in the heart of the market. Let's call it 1 to 5 million. Actually, new development sales were up 7% in 2019 versus 2018. So we're definitely seeing improvement there as people respond to that newfound value, although it is quite divided between winners and losers, so to speak, and more of the projects that are opening, if they're opening with that correct pricing, they're doing very, very well. We have a number of new projects still in pre-sales that opened in 2019 and have had incredible response from buyers and brokers. And then we're seeing all the projects like this one that are now at occupancy. In the fourth quarter, new development signed contracts, 92% of the new deals were in buildings that were immediate occupancy or just 6 months away from delivery. So that pre-sale market is almost gone. The pre-sale market that is there is only concentrated in a couple key buildings. So it's kind of obvious, right? Buyers are a little bit afraid of the future. They want to fall in love and see the space. They want to come into it and experience it. So that's where the sales are happening.
I'm scared to say anything because I know Ryan's going to disagree with it. I mean, he's the new development guy. I mean, look, I try to track new development. I have thoughts on new development, but at the end of the day, I'm a data guy, and there's not a lot of data when it comes to new developments. And let's just realize what it is. You got a 200-unit new development, and that developer is putting 30 units into RLS. Okay, so there's 170 units, shadow, whatever you want to call it, that are not marketed or available for us to measure or track, that the developer is selling, showing, well, maybe showing, putting into contract, whatever they're doing, right? So when I look at supply, the number that I have for supply for new development, I'm trying to measure it and see if it's going up or down, is just a fraction of what the reality of supply really is. Now, you could argue, well, why don't the developers just put all those listings on the market so we can count it? And I guess the answer is that the developer has every right not to sell those units. So putting them on the market it just doesn't help them in any way. They could convert them to rentals, they could hold them, so they're not doing anything illegal. They have every right to do that. On the pending sales, I measure supply and pending sales, like supply and demand, right? Pending sales side, you guys know how developers work, right? They sign contracts, but they don't put it into RLS. RLS is our measuring mechanism, and what happens is they'll sign 5 contracts in August, 5 contracts in September, 5 contracts in October, November, December, January, and then on February 5th, they're going to put 50 contracts into RLS of all those deals. And we see a bump. Guys like me and Ryan are like, holy crap, new development contract signed just bumped up. You just look, 90% of them are just a couple of buildings, I saw contract activity in January for new development up big time as well, but it was 77 Charlton that did it. So these are the things, like if I'm trying to measure supply, I'm trying to measure contract activity, get a market pulse to kind of figure that out, it's kind of cloudy. So when I look at what's going on, again, I got my market pulse number here, and I'm using that a lot here. My market pulse is a tool on my UrbanDigs chart room that basically, as it goes up, the market's strong, and as it goes down, the market's weak. So it's my interpretive mechanism to understand. And just to give you an idea of what's leading the pack, I got Hamilton Heights, Greenwich Village, Sutton Place, Soho, East Harlem, Central Harlem, Upper Manhattan, leading the pack, overperforming in new development. Who's not performing well is all downtown, Lower East Side, Midtown, West Harlem, Tribeca, Midtown Center, Chelsea, etc. So I see new developments, and I kind of put them in that category of the higher price point luxury, kind of underperforming the market, struggling a little more, trying to get deals done. I'm a contrarian. I think the new developments are a great value play right now. I think they're down a lot more than a lot of other things are down. I think developers are trying to wheel and deal. I think developers are giving discounts, concessions, paying maintenance. They're doing all these types of things to get deals done. And if you have a good broker that understands this, you can negotiate a very good deal for new
Yeah,
developments.
let me jump in there because I wanted to talk specifically about the negotiability in new development. You know, I'm looking around the room and I see some of my agents who've just done some really excellent deals in some new developments. And you really need this is where we as brokers can add so much value to a buyer in this market. You know, and I think I keep telling my agents, you know, go sell in new development right now on the buy side,
Yeah.
where the money's bigger. And but more specifically, what are you saying, Ryan, as the king of a lot of inventory over Corcoran Sunshine?
So we all know there's a lot of new development out there, and as Noah said, you can't see it all in the listing system. I don't know what the number is right now, maybe a little over 1,000, maybe active new development listings. The real numbers, there's about 6,000 unsold new development in Manhattan, and there's another 4,000 or so under construction that hasn't been brought to market yet. They have buildings that haven't launched for sale. So that is what is underpinning the ability to get a really great value. And most, not all, of the developers, of the sponsors are responding to that. There are 40 developments out there that are offering, before you even walk into the door, a stated incentive or commission that's above 3%, so 3.5%, 4%, 4.5%, 5%. Some that after you do multiple deals in a building, they'll give you more commission. Some of them paying the commission up front. So I think what Ryan was saying is so important, that there is a lot of money to be made out there in new development for agents. There is, excuse me, sorry, I'm a little under the weather. And then there are a good chunk of buildings that just simply aren't doing any activity at all. And that's driving some of these numbers that Noah's talking about. Because the financial district is a perfect example. We have some buildings in that neighborhood that are the best-selling buildings in the city, and then a couple blocks away you have buildings that are going into foreclosure and not selling anything, and that's driving these dynamics, these numbers to be to look much more negative about that neighborhood than not. Tribeca we should talk about too, because Tribeca is definitely a specific case where what's coming in the pipeline is far, far less than what has been built in the past. So all these specific details are going to underlie what is a good value in new development and not today.
As a follow-on to that, is the press helping out in this regard, would you say? They're not
The only
always our
thing the
friend.
press is helping is getting developers to listen to me. So that has been really great because, 2-3 years ago, it was our fault that things weren't selling, right? It was all of we weren't doing a good job, we were lying, blah, blah, blah. But so now people kind of understand that there's a lot of things happening in the market, and they are responding finally to that because they're under pressure to, or they're understanding that they need to. But other than that, no, the press is not helping.
Do you know what I hear? Do you guys remember the mansion tax last year? You guys remember the mansion tax in July? A bunch of deals, I know, right? A bunch of new development and high-end deals were pulled forward to beat that mansion tax. I mean, and there's great incentive. They were probably saving $20,000, $30,000, $40,000, $50,000 in closing costs. So it's interesting, right? Because like we, as data guys, in Q2, those sales flew up and the market was up 20% because the percentage of closings in new development and luxury kind of spiked relative. So the Q2 2019 report showed the market up 20%. It stole that from the future, so the Q3 2019 market showed the market down 20%. And I think a lot of agents were like, that was the biggest thing. They saw these headlines, the market crashes in Q3, and sellers started like, oh crap, maybe I do have to lower my price. And it makes me realize, I can't believe they have to see these headlines to actually listen to what the agents are saying. They're not believing us. So.
Thank you for that. That's a great response. Deanna, circling back about Tribeca specifically in this particular part of it, this sort of, southeastern area. What are you seeing?
Well, there is a lot, and for those of you who don't know, this area is being really massively developed. As you know, we're next door to 30 Park Place, which is a Four Seasons, and it's done very well. This building has done remarkably. I mean, they're closing in on 50% sold, which is amazing considering it has only been open, fully constructed very recently. And in fact, many of you may have seen the headlines that the head of the Real bought an apartment here, a full floor. So there's a lot of celebrity kind of, and then a lot of people, we're seeing a lot of different people coming through this building. One of my team members sent me a thing that there is this area is the area of all those like private clubs, like Nexus for those who know it. It's like the Soho House. It's these private clubs that you can join, and they're all in the area. And great new restaurants are either here or coming here. And of course, they're developing Park Row, and there's going to be a lot of retail. And we're so close to everything. We're near the Oculus and all the amazing shopping there. And every single subway line comes down here. And the reason I say that is because I do think, in my years of doing this, that this area, not only is a new development really starting to, it's less about what's being built and more about how the neighborhood is changing. And so I think this particular neighborhood, which is, I would call it East Tribeca for lack of a better term, is actually going to see more purchases and more buying. And I'm not just saying that because I'm standing in the building. I really do feel that this neighborhood is poised to really do even much better, way ahead of, I think, FIDI and everything. But it is, as I see, building specific as well, and I think it's important to know that.
Great, thank you. So specifically, back to my data guys, what is the absorption rate looking like right now?
Right.
In Manhattan and specifically downtown?
Yeah, I got charts on that, so I think I was slated. Let me just go through my little file here. All right, so 7.7% is the answer. So I'll try to hold this chart up. I know it's small, but basically we're at our highs. We're at our highs. So if you think about, let me show you, absorption rate in 2014 was about 2. Okay, 2015 was about 3, and 2016 you're starting to get 4. We're at 7.7 now, so we're kind of at our highs. All this activity that we're talking about is going to take 3 to 6 months to kind of show in these numbers. All of these sales-based numbers are really a rear-view mirror reflection of what was signed into contract 3 to 6 months ago, closer to that 6-month mark. So when we talk about all these green shoots and this contract activity and this act and this urgency and attorneys are telling us that they're getting more deal volume, we need to wait 3 to 6 months. So I think that we're kind of at the highs here. I do think that over the next 3-4 months, this is going to improve a little bit. When I look at Tribeca's at 7.7, but it's down from 12.5 about 6 months ago. So Tribeca was kind of in this underperforming mode a little bit. I think because it's a higher price sector, it's in that luxury sector, and again, that sector has been underperforming the broader lower price sectors of the market. But Tribeca's been going down. So Tribeca was here and now it's here, and Manhattan's just at the lows. That helps.
Yeah, that does. I mean, Ryan, do you want to touch on that too, in terms of also not just the data points, but how to interpret that and how to explain that to our clients? What is the practical upshot?
So there's a couple of things I want to say. First of all, just a little bit back to what Deanna was saying, 'cause, we've been working on things in this neighborhood for a long time, like 30 Park Place, and it really speaks to kind of an adage that I tell people all the time, which is buy on the border. If you're really looking for long-term growth, long-term appreciation, it's those border parts of the city that we know are going to continue to change and morph, and wow, we've really seen it right here in this kind of location. The absorption rates for Tribeca, I think, are going to improve, and one main driver of that is we're just not going to see a lot of new supply coming into the Tribeca market. And also downtown overall in general, particularly for high-rise, view-oriented product such as this. There just aren't very many places that you can build towers or convert towers like this in a good location. So it's interesting, there's almost nothing in the pipeline that is like this with views. In Tribeca specifically, after we get through the things that are currently on the market today, there are a few additional buildings that are under construction, but they're all very small. There's only 36 units coming in the pipeline that are under construction for all of Tribeca. Now there's a few other things in the pipeline that are planned or proposed or people are kind of working on, they'll bring to market when the market improves. But But very, very soon, those sort of supply versus demand, months of supply, absorption rate kind of numbers not only are going to feel the benefit of the greater uptick in sales activity that hopefully will be a trend that continues that Noah was talking about, but we'll also start to feel the decline in inventory because there's not going to be new things coming to add much to that pool of inventory we have right now.
So where is that pipeline concentrated? Is it in certain neighborhoods?
Yeah, you heard me mention before that there's about 4,000 units under construction in the pipeline, and several thousand more just planned. That who knows when that'll come to market. And that is spread throughout the city. Downtown in general, if you look at south of 34th Street, does have a big chunk of that, about 1,500 units under construction downtown, not including about 900 units in the financial district. Most of that is at 1 Wall Street, which is 566 units. But within downtown, there's a lot of differences between the neighborhood. As I said, in Tribeca, it's only about 36 units. Most of the things that are under construction that are opening are actually in Chelsea, in Nomad, in other neighborhoods a little bit further away from here.
Yeah, I got an interesting question I want to ask you guys. This is for the Ryans here, right? When a development starts, like for example, we see a supply problem in the development sector, correct? And that was probably a result of 4 or 5 years ago, those projects being started, and then okay. So it takes 4 or 5 years to go from planning and all that to ultimately building and selling, right? So I think Jonathan Miller had a report recently, there was like 9,000 shadow units or something like that to come on the market. So that's bad for this year, it's probably bad for next year, maybe even creep into 2022. But here's the question, are a lot of builders starting new projects now in the last 12 to 24 months to start building? I mean, the answer's gotta be no, because of this stuff. And what I'm curious, the theory is, where are we in 2023, 24, 25, and we kind of enter that cycle that we were in 2010, 11, 12, when they stopped building in 2009 with the credit crisis, and 3-4 years later, there was an inventory constrained market. 3-4 years later, here we are, they're not building. 3-4 years later, are we gonna go into that other constrained cycle?
So this is my best crystal ball prediction about that. So yes, there are very, very few developers still initiating new projects. You heard Ken talking about one that he is getting started working on, which is the conversion and new construction of Collegiate. But think about that location, 78th and West End Avenue. How could he turn down doing that property?
He's been working on it for a couple of years.
Yeah, and he's been working on it for a few years, right? So the point being, there will be a few more things still initiated coming to market, but they're going to be great projects, great developers, special locations. Those are still going to be the things that'll be happening, but that'll be a small handful of things. So because of that, I think you're exactly right. Come 2022, and this is when I'm expecting inventory to really for sure start turning downwards. Come 2022, we're going to see a massive drop off in new development inventory entering the marketplace, which will be like 2009, 2010, even 2011, where we saw almost nothing entering the market at that time too. So it will unbelievably, I think, change the psychology of the market and quickly start to change the supply-demand dynamics in the marketplace. Cool.
Agreed. I'll defer to my much younger classmate, Ryan, and namesake. But yeah, I mean, I just will remember the January of 2013 when a switch was flipped and suddenly the market went on fire after a few years of being, really desultory, and who can forget 150 Charles and 10 Madison hitting the market? They were the only new developments that had come on in years, and it was a joke. I mean, they sold so quickly and at great prices. So hopefully we'll see that, but be patient. He said 2022. Let's look at the buy side. What about international buyers? Everyone loves to ask about them because everyone is under the impression that they buy everything here. Has there been a decline or an uptick in 2019? And what percentage of the market do they make up? And, Deanna, are you working with any?
Well, yes, but and I'm going to actually defer to Ryan for the actual data because it's only anecdotal that I can come up. We're seeing some, but as everybody knows, there was a big drop off because the dollar, which was very cheap, was going down and down, and 10, 11, and 12, and 13. It was so cheap and there was money flowing out of China and Russia and Europe because Europe was in a recession. But now, I mean, that dollar started going up, and I think it was mid-2014 is when it started to increase in value, and it really took off 15, 16, and China put the brakes on, and all sorts of things. So we saw a real diminution of Chinese and other foreign buyers in our marketplace just because it was a lot more expensive to purchase given their currency relative to ours. And there were more restrictions put on, like the LLC and the shell company rules, if people don't know about it, where disclosures were required. And that also put the brakes on foreign buyers coming to purchase. So we are still seeing people come, but I'm curious myself as to what the ratios and the numbers are. So I'm going to hand it over to Ryan.
Yeah, so those reasons for it are exactly right, and that's when we saw the big drop was in sort of 2015, 2016 because of those things that Deanna outlined. But right before then, at the peak of the market for international buyers, they were representing about 30% of buyers in new development, and of course a little bit less in resale condo and a lot less in resale co-op. Nowadays, that's fallen to about 20% of the buyers in new development. So, and that's at the same time that overall new development sales have also come down in that time frame. So the drop off in international buyers as a absolute number is almost like about half of what it was a few years ago in its peak. If you look at 30% of the strong sales versus 20% of the lower sales that we have today. So there definitely has been a decline. Still, the largest number of international buyers are hailing from China. That hasn't changed despite the issues with getting money out of China, etc. So that'll be really interesting to see how that continues to play out. Of course, with everything that's going on there now with the quarantines, it will be temporarily difficult, I think, for the Chinese buyer to come to New York City, as well as to get money out, especially because there's travel restrictions. So that could temporarily sort of destabilize the international market a little bit. But I think long term, instability in other parts of the country make people want to put their money here. Even though we all are feeling there's some instability here in the U.S. and in New York, but to many outsiders, it's still, you know, a great safe haven for their capital.
For global capital, you mean?
Exactly.
Yeah, despite everything else, domestically and capital controls. Okay, great. So what about in general, the new development buyer? Who is that buyer? Are they buying for investment? Are they buying for, second home? Primary use.
Yeah, that's been another one of the changes we certainly have seen over the past few years. The proportion of buyers are much more concentrated towards primary homeowners. Remember, I was talking about the percentage of deals that are happening in immediate occupancy buildings. That also sort of suggests why that is, right? The people that are more active in the market today are people that are having lifestyle or household composition changes. So therefore, they're looking for somewhere to move in right away. So the primary buyers in new development represent about 2/3 of the deals that we're doing, and with the other third divided between second homes, people buying to invest and rent out, which I think is actually going to be a trend of increase through the next few years. With this greater value in the marketplace, that tends to attract investors, many of whom have pulled back a little bit prior to this because of the change in the 421A tax abatement program, making it harder for them to get the same kind of returns when they rent out the apartments. Well, now prices have come down a little bit, and with everything, I don't want to get into rent laws, rent regulations, all that stuff, but with everything happening in the rental market, we are seeing an incredibly strong luxury rental market in condominiums. So I think that's going to induce some more investors to come into the marketplace.
Interesting. And just a quick follow-up, I mean, do you think, in my experience as an agent and as a manager, there are certain buildings that tend to be more, investor heavy, right, in certain neighborhoods, right? Do you find, has that changed at all? I mean, everyone, of course, Billionaires Row is popular with an international crowd, with, certain buildings more so with investors. Any sort of color you want to add on that?
Yeah, that's a good question. I would say a couple things. Number one, international buyers, much less wedded to specific locations. It's not just about Midtown anymore. They're looking at buildings like this, for example. They're looking all over the city. So that's, I think, a good thing that the market has sort of dispersed and opened up and diversified a little bit in that respect. The investor market naturally is looking at mostly studio 1 and 2 bedrooms if they're going to be renting out apartments. So that tends to therefore then concentrate in certain parts of the city where you would expect to find that kind of product. The thing is, because of the supply versus demand being so out of whack for large residences, you're seeing smaller residences now being built in more neighborhoods around the city. So I think that there's going to be great investment opportunities throughout for somebody who's looking for a smaller apartment. I feel bad talking about a different project when we're at a project that we're trying to sell, but one that's an example of that is the Park Loggia at 61st and Broadway. You know, if you know that building, that was actually initially designed as a rental, so it has much smaller residences than you would have built, planned if you had intended to build a condominium all along. So it's a great sort of outlier in the market, a project that's doing well because it has different types of inventory, both for people looking for pied-à-terre or a primary home in the city, but also for investors.
We're almost to the end of our questions, just so you know, but this is what I would call sort of the $64,000 question that I certainly get asked almost daily. Why do you, Noah, I'm going to start with you, why do you think that New York real estate prices are down when the general economy is strong and the stock market is up?
Yeah, and it scares me a little.
And we get asked this question all the time.
I mean, all right, Ryan, earmuffs.
Which Ryan?
This Ryan. Look, the buy-rent equation doesn't make sense. All right, it is cheaper to rent than to buy. It's as simple as that. All right. Now, why is that the case? I think it's a policy-driven reset. I mean, I think the Manhattan is more expensive. It's more expensive if you're a buyer looking to own in Manhattan. The SALT property, the SALT deductions are there. You have the mansion tax, you have the rent regulations, you have the strong US dollar, you get the China capital. All of these policy things have been negative for the sales market, and at the end of the day, more people are renting. The rental rates have been kind of going up a little bit. Vacancies are very, very low at 1.2% or something like that. And the sales market has been going down, you know, ironically enough, since all these policies started happening.
And that's in spite of low interest rates.
In spite of low interest
And
rates, a booming
negotiability.
economy, and a stock market that's going berserk. Now that scares the crap out of me. Because what if the Manhattan real estate market finally over the last 3-4 years, we had a divergence. The real estate market usually tracks Wall Street, usually in the economy. But that did one thing and the real estate market did another thing. What happens if we still do another thing, we start to come back, and then the stock market crashes finally? Do you know what I'm saying? Like, so that scares the crap out of me. What happens if all the supply-demand dynamics, everything starts to make sense, the rents got up too much, it's starting to make sense to buy now, we start to get going, buying starts going, and then you see a 15-20% stock market crash for the next 2 years. How does that affect consumer persona for consumer behavior for our products? It's all about the bids. It's all about the buyers, it's all about the bids, it's not about anything else, and you gotta look at what the buyers are doing. And again, that spread was what was telling us. I think they're starting to realize now that it's a decent time to come back in, and that's why they're doing what they're doing. I just worry that something outside either the economy or the stock market is going to potentially disrupt our turnaround that may be forming right now. That's my concern.
Okay. I mean, oh, Deanna, sorry.
I was just going to say, I mean, I think we just have to make hay while the sun shines, and also it could very well continue. And I think that what is happening is that people are finally, there is a lot of pent-up demand out there. Don't you feel that?
Yeah.
Yeah, I mean, people are not buying because they're nervous, and while it could be hit, I mean, these are the people that if that does happen, it could be a very short-lived kind of experience, let's hope, that would turn around. Like, if those of you were in the market when 9/11 happened, and many of us were, we all thought the world was going to fall apart and never recover, but there was so much pent-up demand and so much desire. It was a whole different thing than an economic catastrophe, although I was there in Black Monday and a lot of others. And depending on the circumstances surrounding everything, it could be a slow, but I do think there are people who are still looking for, that may be the indication that it's the bottom, and it doesn't take a lot. It seems to me, and every time we've had some sort of an economic catastrophe, it's been anywhere from a few months to a year till people start jumping back into the market, and then it tends to take off at a fairly sizable clip. So I wouldn't be, markets come up and markets go down, and we just have to roll with the punches,
Thanks. Yeah, I'd love to jump in on that too, because this is something that we really try and maintain, right, in the office, some sense of optimism, despite all of what we're talking about. And were you trained as an economist, the decimal science, or just
Me?
Yeah, you just come to it naturally. Just kidding.
Psychologist.
Well, we have to be a little more optimistic, we brokers, client-facing and all. So what I say is, we've been through worse, as Deanna just said. I mean, the 08-09 collapse following Lehman Brothers, et cetera, and the economic fallout was the worst, it was a 100-year flood of recessions. And so we've definitely been through worse, and I think people need to remember that. This has been an especially frustrating market because it's been happening so gradually. And over several years, versus then it was very clear what happened. It literally changed overnight. But New York was the last market to fall. It was the first market to rebound. So we've shown the investor, be they for a real investor or just the buyer, that we've been through worse and we've survived and we've maintained value throughout. Yes, sure, some people may have not come out whole, but by and large, our market has survived. And I think to me, Deanna, it's coming back to that granularity of deal by deal. That's why we make sure to communicate about that in our sales meetings. We just saw this move into contract, and somebody just did a deal at 550 West 29th, or we just sold the fourth unit at 515 West 29th, or actually it was Kane Manera here who brought the real lady to buy here. Hi Kane, congrats, and did a really nice deal here. So we have to remind ourselves that we are getting deals done, and they may be challenging, but if we've got the right buyer and the right seller, a deal can happen. And I think we have to preach that to our clients as we speak to them.
And I'll just say one thing, when markets do go down, it is a really great opportunity for many people to move up or down in price, because moving up often, if they even take a loss, they move up and they're getting a great deal. So I think the thing to do is to maintain as much optimism in a general sense as possible, because when everybody else is down, you'll shine and you'll be the person who people want to work with, because you have not a Pollyanna, but a sort of a bright, let's look at the things that are good about whatever it is. That's what I've been doing all this time during this market that's been challenging. But I've done well. The times I've not done well is when I've been down about it. When I've decided that I'm going to take the bull by the horns and work through this market, that's when I've done well. And I've tried to do the best for my sellers, the best for my buyers, and it all works out. So I hope that's helpful to you. Anybody else want to say anything?
As I was saying, just remember in 2013, 14, and 15, the buyers wanted options, discounts, and one-on-one negotiability. And when you look at the market today, they're getting discounts, options, and one-on-one negotiability. So they're getting everything that they asked for in a market 5 years ago that they couldn't get, and they were bidding ferociously for. So you just got to explain, the hits happened. We're down. We're done. It's happened already. We are bumping along the bottom trying to find our way. And if you're happy to buy right now, all these negative things that we brought up is already baked in the cake. It's already there. So they need to understand that.
Yeah, and I totally agree with everything that everybody said. Just as a final thought, there are still over 10,000 transactions that are occurring in this marketplace over the past couple of years, and I expect to be at least that this year. Now, on average, over the past decade or so, we've seen about 12,000 transactions, so it's down from that, but there's still a lot of activity happening, so it's about how can you be the person that's doing one of those, or many of those, 10,500 deals in the marketplace. But what that also says to me, and I thought Deanna hit it right on the head with the pent-up demand that's building in the market. I am seeing that. The traffic across our new developments over the past few months has been the strongest we've seen in 5 years. There is pent-up demand in that marketplace. That differential between that average number and what we're selling right now is literally the pent-up demand that is building. Those 1,500 people that aren't buying right now are out there waiting and ready to be convinced it's a good time.
Thank you. So we have some time for questions. This lady in front had been waiting patiently since early on.
I just wanted more about the correlation between the stock market and the real estate market. Before 2016, I have seen, at least in Harlem, selling small buildings, townhouses, that people would come and basically the buyers replaced the stock market with real estate. It became their stock. you know, and I just saw that trend and I was talking with international people, they wouldn't, you know, they were afraid of the stock market, and now it's really kind of, in my opinion, speculative, and it's at a, you know, very high, and if something gonna go wrong, I don't know, it's an election year, may not go wrong, it's just right, but if something will go wrong, basically we're gonna, and they, no? I mean,
So let me just repeat the question for those who can't hear. Essentially, this is about the correlation between the equity market, the stock market, and our market, the real estate market, which was kind of going hand in hand for a while, but not so much anymore, and why?
2 letters, QE, quantitative easing. All right, the Fed is trying to get investors to invest further out in the yield curve and get yield, okay? The stock market is one of the biggest and easiest and liquid, transparent marketplaces to do that in. And when I look at the stock market, it is just juiced. It's juiced. I mean, it's.
I agree with you, but I have people that are telling me, listen, I'm making now more money quicker in the stock market, I'm not gonna invest in yours, whatever.
You know what?
I get it a lot.
I'm in no position to tell someone whether or not to put their money in the stocks or in real estate or what either is going to do over the next 1 to 2 to 3 years. The question was why is the correlation not there? And the answer is QE. The answer is that this is a Fed global central bank manipulated environment where the pricing, I'm trying to word this properly, the pricing of risk is completely off the charts wacko right now. You got $18 trillion in negative yielding bonds out there. Negative yielding bonds. People that are giving $300 million and I just want my $300 million back and I'll pay you $3 million to get that money back. So I'm not even getting my full money back. That tells you that people everything's whacked out, distorted, for lack of a better word. And it's going on right now, as we talk. It's still happening. That is the answer to your question. They're not putting their money into it's goosed real estate a little bit, but on a national level maybe, New York City I think has diverged because of the policies that were enacted in New York City, and that market was always doing its own little thing, and then it continued doing its own little thing. But I look at the stock market is doing what it's doing because of the juicing and the Fed and global central banks and QE, and it's going to continue doing that until that gets reversed. It's just a
Great
big
answer, thanks Noah. And as the only manager in the room, I'm going to take this opportunity to remind everyone that you're not financial advisors or attorneys, so please refrain from giving that kind of advice to your clients. Do we have any other questions? Yes.
My question is about the inventory that's priced above what the supply or the buyers are looking for. What would you say would happen to that inventory? Because you mentioned that that's what's dragging the market, the new development market. Are the developers going to eventually decrease the price, or would those become rentals? Like, what would you say would happen to that?
Yeah, that's a good question. So the question was about the biggest oversupply in new development inventory is at the high end of the market, the higher price points, over 5 million, over 25 million. So what is going to happen to all that supply? So a couple of things I think are going to happen. It's no one answer, and it kind of depends on the specific circumstances of a lot of the developers that are holding that inventory, or the partners or lenders behind them, screaming at them. So in some cases, they might rent some of that inventory. In fact, over at 100 Barclay, we're doing a rent-to-own program at some of our 5 million and up, beautiful large 3 bedrooms that are taking a long time to sell, and that has been very successful. I haven't seen a huge switch to rentals in the marketplace because the numbers are just hard for developers to make sense of, but you will see some of that. You will see some of those apartments being sold in bulk to people that then might hold them for a while and sell them when the market improves, maybe rent them in the interim. I haven't seen much of that yet, but I'm getting a lot of requests for it. So if anybody is interested in that kind of sales, I mean, that is something to maybe look towards out there to do some deal activity on a bulk purchase scheme. Third, you will absolutely see the prices have already kind of come down the most in that sector of the market. There's the most negotiability in that sector of the marketplace. On average, new development negotiability in our portfolio is about 8%, inclusive of discount off of price and credits, but at the higher end of the market, on average, it's more like 15%. So the number might be 5% on some buildings and 25% on other buildings. It's not 15% across the board, but that's where you are seeing more negotiability in the marketplace, and that will definitely continue to help that inventory clear out. The other issue with that inventory is it's not all created equally. Some of that inventory is in beautiful buildings that are complete. A historic landmark like this with views is very different than some other places where people have built large apartments in locations where people just frankly don't want them. And that stuff will take more of a haircut on negotiability. Somebody else might control that development sooner rather than later. And in some cases, you might even see some of those residences being split in half if it's not too late to do that.
Yes.
Okay,
Here.
this is mainly directed toward Noah, because you were talking about this all being policy driven. And what I would question is, the way I saw it was 2015, I think, was a bubble. I think that people were bidding ridiculous numbers just because it was low inventory, high demand. And then people suddenly started to realize by mid-2015 to late 2015 that this is crazy. And they just stopped. And that since then, it's been tumbling and it fed on itself. And I think policy had something to do with it too, but I think that more of this was simply that people said, these prices are nuts, I'm not going to buy now. And eventually, now we're coming to the point where there's more inventory and there is pent-up demand, because people really do want to buy.
Yeah.
But I think that was really what caused this downward spiral. That it just started and it snowballed into prices dropping.
Yeah, and usually when these things start, they kind of feed on itself, and I think it was Ryan.
Sort of restating the assertion.
What's that?
Can you just sort of restate what he said just so?
Oh, he was basically saying, his question was that 2015 was a bubble, that those numbers were really not realistic, and that the policies had something to do with it, but really what we're going through is a market kind of normalizing itself to unrealistic prices, and is this what you're basically saying? In 2015.
And now even dropping way beyond what you might think is a correction, because it just fed on itself.
Yeah, and that's just the nature of these cycles. These cycles, they have that stock market curve where it goes from denial to parabolic to euphoric, and then all that kind of crazy stuff. That happens for real estate too. You have to understand this market does not operate in a vacuum. This is an illiquid real estate market that we don't know what places are worth until we kind of put it out there. At all times, this market's trying to figure out where it is, including in 2015. It just got to, when I look at 2015, there was no inventory, there was tons of demand. All the policies that we've talked about didn't come out yet. Maybe there was, all right, the stock market is a discounting mechanism with all the information readily available. Stocks are at their price given what we know now. If tomorrow something happens that's really, really bad, the stocks will open up much, much lower, and they're taking that information and doing it. Real estate's doing the same thing, and it was doing that in 2015. It's just there was no reasons for it to kind of bail out on itself. Once it started happening, the policies just exacerbated that whole fall, in my opinion, and it just distanced the bids from where the asks were, and that's what caused this whole problem. I mean, basically, when bids and asks spreads widen, sales volume falls, deal volume falls, and sellers are sitting there wondering, what the hell is my place worth? So in an illiquid market that doesn't operate in a vacuum like real estate, where we don't have that transparent stock price right in front of us, dollars and cents and pennies, that I can unload my stuff right here at that bid, this kind of stuff happens, and it does feed on itself. And if there's one sector or one asset class that is impacted by emotions and people, it's this. So it's not surprising considering what we did. It was very well could have been a bubble. It very well could be that right now prices are too low. We just don't know it yet. So we can go both ways.
Because there's a real lag factor.
Yeah.
Yes, Elaine.
Looking ahead to when salt will be mitigated and the world will be a better place. Young Ryan in the middle. Are people coming to you, because nationally we're seeing the shrinking of the American home from, say, my childhood, and are people coming to you with what I would describe as smaller, more efficient projects? Like, I can remember from the beginning of the new development phase that you would always kind of have a mix of units, because that would fill many things. One, the people who are in household formation could afford to buy. The people who are selling big places would have places to go, right? And you could design something that could go into being a rental. I mean, that's kind of a lot of planning.
Right, so,
But with a great architect, you could probably overcome all those problems. And are people coming to you? like
right, so
that?
so the question is about how is the planning of some new developments going forward changing based on what we're seeing in the market, right? Because it is a trend that we've seen worldwide, nationwide, towards living in some smaller spaces. And New York, through at least the early parts of this cycle, didn't follow that. You know, when we look at what was available, the last time we had a similar amount of unsold new development inventory in the marketplace was in 2009. There were also around 6,000 units. The value, the asking price of those units at that time was $15 billion, and the average size, if I remember correctly, was around 1,200 square feet. Right now, the about 6,000 units that are unsold, the value of those is $34 billion, more than double. And the average size is more like 1,500 square feet, right? So it's gone up about 25%. And that speaks to where we have more of the glut of inventory is in larger apartments. So you're exactly right. On the newer things that we have been planning since the writing was sort of on the wall with this a few years ago, is skewing smaller when and where it's appropriate and possible. And I think the next generation of things to come, with the exception of a few things that are in very prime locations, you know, we're working on a project on East 79th Street between Park and Lex. That's not going to be studios and one bedrooms, let me tell you that. But things that we're doing, you know, in the financial districts, things that we're doing in Chelsea, you know, neighborhoods where really need that supply of smaller residences, that is exactly what's happening.
Right, because that also goes along with the trend towards much smaller households.
Exactly, yep,
The
exactly.
whole thing is kind of working together.
Exactly.
I think we should, call it a wrap at that moment. I want to thank the panelists who've been fabulous. Deanna, Noah, any other
Thank you all. I couldn't have done it without you guys. Are amazing. And thank you all for being there. Please take a few minutes if you can to go see Pavilion A next door. And if you have a moment to go up to, what was it, 36, did I say? Please see that as well. Thank you again.
I know. Can I just say something in the middle of